Ladies and gentlemen, welcome to another episode of the Diligent Investor Digest, a channel that aims to empower the everyday individual to make better financial decisions. In today's episode, we're going to be discussing why, despite the endless promises from the Bank of Canada that interest rate cuts are just around the corner, we're not able to observe anything of the sort in the broader market. In fact, bond yields are continuing to climb, and as we will see right now, fixed rate mortgages are also on the rise. So let's get right into it. We have for us today an article published by Global News. It's written by Craig Lord. Some fixed mortgage rates are up despite hints of Bank of Canada cuts. Why? I think it's a bit of an understatement to call what the Bank of Canada has been doing for the last 2 years hints, but nonetheless, it's a really good question to ask. One of the opening paragraphs tells us that mortgage experts who spoke to Global News say despite the Canadian Central Bank opening the door on rates coming down by mid-year, stubborn economic data in the United States might play spoiler for prospective home buyers eyeing the spring market. And that's basically what I've been saying all along. Tiff Macklem can say whatever he wants and share whatever opinions he wants, but at the end of the day, interest rates are going to be in large part driven by what's going on in the larger economy. United States, being 60% of the world economy, is a big player in that. Canada, being 2% of the world's economy, is not. Furthermore, if the Bank of Canada wasn't broke, as it is right now after the leadership of Tiff Macklem, then the Bank of Canada could potentially be in a position to lower rates to stimulate the Canadian economy, and everybody knows that it certainly needs stimulation right now. But because the Bank of Canada is broke, it experienced the first ever losses in history under the leadership of Tiff Macklem, they're not even in a position to do that. So at this point, the Bank of Canada has absolutely no choice but to come along for the ride of what happens with global interest rates in the larger market and try to save face and tell the Canadian public that whatever they're doing for the greater good. So now let's go to the other side of the story. 5-year Government of Canada bond, the one that informs 5-year fixed mortgages, and if I may add, one of the rates that the Bank of Canada should be keeping in check as well, topped 3.8% on Monday morning before settling down somewhat. That compares to yields of 3.4% 3 months ago and 3.6% a month earlier. So it doesn't take a rocket scientist to figure out the trend here. Bond yields or interest rates are rising, and they've been rising for a very long time. James Laird, the co-founder of RateHub, and also a person that doesn't have a specific agenda when it comes to interest rates, says that there is upward pressure on fixed rates right now. While inflation has been trending lower in Canada over recent months, the annual rate cooled to 2.8% in February from 2.9%. Is that a cooling or is that a rounding error? I'll leave it for you to decide. Many economists expect an uptick in gas prices last month. We'll see the overall inflation rise in March. And I love how this article is written as if the government had absolutely nothing to do with the uptick in gas prices. Now we have some more quotes from the co-founder of RateHub, Mr. Laird. Right now, I think Canadians are expecting rates to drop. I would add that they're not just expecting rates to drop, they're being told by every talking head on TV that rates are going to drop. That's driving a lot of the demand, and if the narrative changes, expect a lot of people who are currently in the market to go back to the sidelines like they were in the second half of last year. He's of course talking about the real estate market. Even with talks of rate cuts in the cards, Laird says that it's wise not to assume rates will be dropping from this point. He advises prospective buyers to get a mortgage pre-approval as soon as possible to lock in the rates at current levels to insulate themselves from possible future upticks and borrowing costs. And if you've been watching this channel, it'll come as no surprise to you that I concur with this opinion. Interest rates are set to rise. They're set to rise simply because of the risks going up in the larger global economy. The wars and geopolitical tensions that we see around the world are one of the key drivers for that. Unfortunately, we don't see anybody talking about peace, so it's not far-fetched to expect wars to continue. So in my opinion, it's not a bad idea to lock in your mortgage for the next 10 years or even 15, especially if you can get a rate somewhere around the 5%, which is historically still very, very low. Now, if you enjoy videos like this that give you no-nonsense insight into what's going on in our capital markets today in Canada and around the world, don't forget to hit the subscribe button and hit the notification bell. Please leave a comment. This is a new channel and I need all the help I can get to get it off the ground. Thank you for watching, and I hope to see you in the next video.